what's the outlook looking like for FY19 or 2019? Because somehow from the Fed side, 2018 seems to be a known devil, if you will. Andrew Freris, CEO at Econogsis Advisors, joins us right now from Hong Kong. Andrew, good morning. Thanks so much for taking the time out. Not surprising, really. I would reckon not even the dropping of the word accommodative was not surprising. And I think they have laid their hand bare when they have given out that there will be one more rate hike in 2018. Anything that stood out for you from this policy statement? And what's your outlook for 2019? Does the Fed stay on course for the number of rate hikes that the market expects it to do?
Well, they have been incredibly persistent and consistent. And don't forget, they started raising interest rates in the year 16. This is nothing, absolutely nothing new. There is no news here at all. And they say they're going to raise rates. They don't necessarily raise them exactly on the month we expect them, but they're doing so. And of course, don't forget, they started, if you think that the rates now are between 2 to 25, okay, which is unbelievably low given that the economy is growing at 3%, and they started nearly 2.5 years ago, it shows you still how low the rates are in relationship to everything else. Normally, the rates plus the real rate of growth should equal more or less. The nominal rate of growth should equal roughly the interest rates. That's an incredibly crude way of looking at it. And we're not really there yet. In other words, if inflation is about 3%, then if nominal rates are 3%, then real rates are 0. And the economy is growing at 3%. So in other words, this is a very crude way of doing it, I emphasize. Okay, so yes, I think they will hike again before Christmas, and possibly they may consider at the very least 2 more hikes during year 19. No surprises here.
No surprises here. I think the market started reacting a bit when the word accommodative was dropped, but I think Jerome Powell made it amply clear that it was not a policy signal.
This is the usual thing. It's like reading the Holy Bible, if you excuse my politically incorrect thing. Individual words have got huge significance. Did they say accommodative, or did they say easing, or did they say in the near or in the long future? They have said they're going to hike interest rates, and they will.
Well, Seth Freeman of Glassratner Advisory and Capital Group joins us as well. Seth, Andrew Freris was just saying that there were no surprises here. Somehow, of course, I think everybody agrees. No surprises. One more rate hike come December. The question mark only, therefore, is about 2019. Do you reckon that the Fed or any of the watchers are underestimating the power of the wage growth, underlying wage growth, and the impact that it has on inflation, and therefore the possibility of the Fed having to hike more aggressively than what the market or the Fed itself believes right now?
Well, there's a couple of things working at the same time. Don't confuse higher employment rates necessarily with higher wages. It's true, we're seeing significantly higher employment rates, but we have not seen in most of the country higher wages. So we're not really seeing inflation coming from there. Frankly, the tariffs, the trade war, and the price of oil will probably have more impact from an inflationary standpoint, both in the United States and globally. We also have a situation where mortgage rates are rising relatively quickly compared to the last 2 or 3 years. And the U.S. economy is very dependent on real estate. Imagine somebody buying a home has an empty garage. They might buy a new car and furniture and so forth. And the housing market is flattening out quite a bit. And so, on the other hand, the cost of home ownership is rising rapidly. Right. I think those are going to have much greater impacts.
So what's your assessment of what happens post-Christmas, Seth? On track for the stated objective or the believed stated objective of the rate hikes at the pace that everybody believes the Fed would do in 2019?
Well, this goes back to this idea for many years that the Indian market is very sentiment driven. At the moment, consumer sentiment is very high. And so expectations for Christmas are very high. And that could carry forward through to 2019. The from a more macro standpoint, we're seeing a flattening of the yield curves, and that usually bodes negatively for the future. So I think the Fed is just going to, like your other speaker mentioned, in many ways this isn't a surprise. I don't think dropping the word accommodative should be given a whole lot of interest. They're going to continue being data-driven. And on the same token, I believe the Fed's going to be very sensitive about avoiding raising interest rates too aggressively and forcing a recession. So probably 2019, we'll basically see more of the same.
Andrew, just one final word, and the impact that this hikes, as moderated they are and as on expected lines as they are, the impact that they have on EM flows. India has specific problems, but EMs at large or Asian markets by and large, any major impact on flows because of the Fed decisions?
Basically, no. Let's not forget the RBI started to hike interest rates back in April after it has lowered them for several quarters. So Indian interest rates are already on an uptick, and of course with the weakness of the rupee and the, let's say, if inflation, and that unbelievably, if I may say so, stupid policy decision to impose tariffs, for God's sakes, in order to repair the current account, it will only push inflation up. And therefore, it will make quite sure that the RBI will continue to hike interest rates irrespective of what the Fed did. Watch my lips.
Okay. Andrew Freris, thank you so much for taking the time out and being with us. And Seth Freeman, thanks for staying up all the way from San Francisco. Thank you so much for joining in today on Bloomberg Quint India.